The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
Inflation pressure builds, and so too does the pressure on the Fed. Live from Studio 2 here at Bloomberg headquarters in New York, I'm Romaine Boston.
And I'm Scarlett Fu. We're kicking off to the closing bell here in the U.S. on the eve of Jay Powell's speech.
Yeah, big one.
All right, let's take a look at what's going on here. We have the S&P 500 declining for a fifth straight day here after a report showed a rebound in manufacturing, which could darken the outlook for rate cuts. You also have, interestingly, small caps outperforming. The Russell 2000 gaining 0.3%, with healthcare leading the way. So is this part of that rotation narrative that we've been hearing about? Yields are higher across the curve. You can see the 10-year now at 4.33%, and the Bloomberg Dollar Index adding to its gain after the release of that manufacturing data. Romaine.
Interesting moves in the market. 5 days of losses in the S&P, 3 days of losses for the NASDAQ 100. A trifecta of losses, the first trifecta of losses for the NASDAQ 100 since March. It's a 3-day, almost 3% slide that, to be fair, was actually foreshadowed by a pickup in options activity, a pickup that is now picking up, well, even further. But I had a chance to catch up with Brent Thill yesterday, and, well, he's not shook just yet, saying that the market pullback is still modest and not cause for alarm.
I think it's orderly. It's not been violent. Our trading desk has seen, 7 straight down days, very consistent, no one freaking.
The view from the trading desk at Jefferies. Meanwhile, at the trading desk over at Goldman, they say the recent losses in high momentum stocks may actually be a dip buying opportunity, particularly given the bullish signal that more than 60% of S&P 500 members are actually above their 200-day moving averages. But of course, seizing that opportunity isn't just about technicals. It's also about fundamentals, economic fundamentals that are pointing to inflation pressure. Exhibit A, the S&P's latest factory purchasing managers index today showing services companies affected by tariffs, they're passing along those higher costs to consumers at the second fastest rate in 2 years, and price hikes from manufacturers, those right now are among the second steepest increase in about 3 years.
Yeah, which of course renews the concern about inflation. So when we look at the market, as mega cap tech names extend their losing streak, one consistent narrative is that there's a rotation taking place within equities. Investors shifting away from super expensive Mag 7 names and adjacent companies to something offering better value, like small caps. So what this line does is track the performance of the Russell 2000 relative to the S&P 500 over the past 5 years. So when the line goes down, like it basically has been since early 2021, that means that small caps are trailing big caps. So the rotation into small caps that we've seen the last few weeks, right over here, highlighted in white, on the idea that they would benefit more from an interest rate cut, is still minor in the big picture, as to almost remain not even count.
Amy Silverman joins us right now to kick us off to the close, equity derivative strategist at RBC Capital Markets. And Amy, I don't know if you had a chance to actually see that chart Scarlett had up, but it gets to the idea of the market moves over the past few days and really the past few weeks. Does that actually dovetail with what you view as appropriate positioning?
So it's interesting because, when we specifically talk about the small cap versus large cap trade and growth versus momentum, I'm a little bit still in the camp, Romaine, of boy who cried small cap. In just that I've seen this movie so many times, it always kind of precedes this potentiality of having a rate cut. We never see it come to fruition. One of the main reasons, and I continue to harp on this as it relates to positioning, is when you talk about small cap or value, it does not have this aspect of benchmark FOMO. So essentially, when a few names like the Mag 7 contribute so much to the concentration of the index that investors feel like they must be in them to participate in upside, you just don't get that yet with small cap. It doesn't mean the trade couldn't work. I think I would just need to see a few more data points.
I am curious there. I saw in some of your notes here, you're actually advocating that maybe if you do want exposure in that area, the idea to use call spreads, the idea of basically going long on, I guess, a price that's closer to where we are today and then shorting the prices that are a little higher out. And that's on the Russell 2000 ETF that tracks the Russell 2000. Is that a fair characterization?
Totally fair. So IWM essentially your proxy for Russell 2000 as an ETF, extremely liquid from an options perspective. I would say this is a popular trade for those who do want to express that idea that, small caps could have their day in the sun, but they don't want to outlay a lot of premiums, so that payout that you get on those call spreads are very high, essentially because we do see investors come in and say, hey, maybe this time around the movie will play out in their favor. But again, they don't want to put all their funds in that trade and just move that rotation out because, again, that benchmark FOMO doesn't exist. So options becomes a good strategy to kind of lever to that idea.
Amy, I wonder if small caps have just become kind of a trade, a knee-jerk reaction to talk about a rate cut rather than anything else, because I'm not sure that I really see anything that sparks long-term interest in this group beyond hopes of a rate cut. It's not like, or extreme value. It's not like earnings gets people going.
Yeah, that's exactly right, especially when you kind of think about the Russell 2000 and, having to throw out the negative earners, stuff like that you have to do to make the kind of the math work. I think it has become a trade for folks who look at these nosebleed valuations on some of the Mag 7 and look at the over-concentration in the market and just say, hey, is that healthy, Scarlett? Like, do we think this is a healthy way for the market to be? Do we think going to an equal weight trade when that spread gets really wide is actually healthier? And this is a tactical way of essentially expressing that, obviously, along with the idea that at some point we do get that rate cut. Certainly something that President Trump does want. Absolutely.
He's made that very clear. Let's talk a little bit about volatility. And one way to measure that, a popular way, of course, is just looking at the VIX, which is at about 16.5. A two-week high, but still well below the year-to-date average of just under 20. You've talked a lot about a volatility pothole that we saw last August. Are we setting ourselves up for something like that this time around?
Yeah, it's interesting because I know the clip you played just prior to me is about how orderly things have been. And I think what investors are doing is they kind of realize that August is a little bit of a liquidity vacuum. And, a lot of people are out of the office. You get these August 5th potholes that happened last year. Obviously, we have not had one yet. But seasonally, August and September are poor months for the market and high months for returns on volatility. So I think what people are doing is they're just getting kind of risk off. I think that's why it's a little bit orderly. But people are saying, hey, Jackson Hole could be quite important considering the cross currents that we're getting from data and manufacturing versus labor. And I think we're just going to take a little bit of risk off the table. That's why it's been orderly. But when you look at a VIX at 16, yes, I agree that's very low, but realized volatility has been even lower, and that's often a transmission mechanism for volatility.
We've seen this kind of play out before with regards to some of those seasonal aspects where you kind of get these moves that are maybe exacerbated by the fact that a lot of folks are away on vacation. And then, of course, after Labor Day, everyone comes back to their desk, and those moves have a way of either snapping back or maybe worsening. But I am curious, Amy, as to what you actually think is driving this market right now. Is this really about the economic fundamentals and tariffs and the Fed, or is this more about corporate fundamentals, or is this really more of a technically driven market right now?
I can tell you from just if I took all the conversations I've had with institutional clients since Liberation Day, I would say the bulk of them have felt like, they didn't kind of catch up with the rip that we got post-Liberation Day. That's one. And two, they've been waiting for Godot in some ways because they've been waiting for this inflection point between the soft data and the hard data. So essentially, like, when do we see tariffs in the numbers? I think that was a lot later than people expected, but people never stopped believing that it was going to happen. And so, you talk about people coming back to their desks in September. I think they're going to be in kind of bad moods. And I think the data is going to continue to confirm what they thought was going to happen way back in April. And it just took longer for you to see that narrative play out both in the labor market and with consumers.
Okay, before even September, let's just talk about the rest of this week. Given the positioning that's out there right now, are we more likely to see no reaction, little reaction, or a big reaction tomorrow?
So given that we've essentially a lot of investors have started to kind of take money off the table, I think that what's going to happen is if things come out more dovishly, so you sort of get a Powell presser that maybe suggests that September is on the table, that the market could react quite positively to that. I think the opposite in terms of positioning has been priced in to some degree.
Amy, always great to have you. Amy Wu Silverman, equity derivatives strategist at RBC Capital Markets, kicking us off to the close here on this Thursday afternoon with all the focus right now on the economic symposium in Jackson Hole. All of the Fed governors, all of the Fed members set to meet, but right now all the attention is on one, Federal Reserve Governor Lisa Cook, and the battle with Bill Pulte, the director of the Federal Housing Finance Agency, who has lobbed some very serious allegations against Cook. We talk to Bill Pulte when we come back after the break.
And of course, Staying with the Fed, a discussion on what to expect from Jay Powell's speech at Jackson Hole with two men formerly ingrained in the Fed. Goldman Sachs Vice Chairman Robert Kaplan and BNY Investments Chief Economist Vincent Reinhart.
And with the market sell-off continuing for just another day here, we're going to talk about the tech sell-off and talk about valuations. Sarah Kunst of Cleo Capital going to be joining us later in the program. Stick around. This is The Close on Bloomberg. We have talked about the Kansas City Fed's Economic Symposium in Jackson Hole, Wyoming. That officially kicks off about 5 hours from now. But right now, everyone is talking about what has actually been the lead up coming into this. A big bomb thrown into the mix by Bill Pulte, the head of the nation's leading finance agency, asking the U.S. Justice Department to investigate Federal Reserve Governor Lisa Cook. Allegations made by Bill Pulte, citing documents that his agency received involving mortgage fraud. The Justice Department has weighed in and said that they are considering looking deeper into the matter. Lisa Cook herself has already responded, saying that she is willing to provide any additional information that the investigators are looking for, but that she won't be bullied into stepping down. I'm pleased to say that Bill Pulte joins us right now. He is the director, of course, of the Federal Housing Finance Agency. And Bill, I do want to start off particularly with the investigation, of course, that you brought to light, that Bloomberg reporters brought to light prior to that, and the documents that are at the center of that, and where exactly those mortgage documents originated from and how they got to your desk.
Well, those are public documents. Anybody who, frankly, can do some research with Google and get to county websites can easily find these documents. You know, the media, including yourself, it sounds like, are going to try to make this into some kind of witch hunt or something like that. Quite the contrary. This is self-evident. This is black and white stuff. And frankly, the fact that the media and so many people are asking questions in the elite class about this goes to show that people think that there are rules for some people and rules for other people. Mortgage fraud is prosecuted every day in this country. And I'm sorry to say, not really, though, that a politician or a public official in this case is now the subject of mortgage fraud. Normal people have to deal with this nearly every day in this country. This is nothing new. Defrauding people is nothing new. And now all of a sudden that you have somebody very powerful, now people have to question it. It doesn't make any sense to me. And I believe that she committed mortgage fraud.
When you look at the documents that you have, the publicly available documents, I am curious whether you or anyone at your agency had a chance to actually speak to Lisa Cook, her lawyers, or any representatives about what you found in those documents.
Obviously, while I respect the question, anything that has to do with the federal investigation, I am not going to comment on. However, I would say what is within the confines of the referral letter, of which I'm willing to speak about.
What is your involvement in the investigation, Bill?
Well, as you know, I'm the regulator of Fannie and Freddie, as well as the conservator of Fannie and Freddie. And so this is right in the bullseye of what my job is. I promised before the Senate, before I was confirmed by the Senate, that I would investigate mortgage fraud. And I'm not going to be intimidated by anyone. I'm not going to be intimidated by the media, the politicians. They can say whatever they want. If it's a Republican who's committing mortgage fraud, we're going to look at it. If it's a Democrat, we're going to look at it. If it's a wealthy politician or a lawyer, we're going to look at it. So we're not just looking at everyday people. And I'd say the one thing, Romaine, which is that we refer people almost every day. I refer people every week on a minimum to the Department of Justice for mortgage fraud. This is literally what I am required to do underneath the Housing and Economic Recovery Act of 2008, which is to ensure the safety and soundness of the mortgage market.
When you say you're referring, you're talking about just rank and file people going through your own agency documents. Is that a routine process, or is this something that has been very specifically started over the last few weeks or months?
We look at fraud generally. We say, look, if everybody and anybody who knows about mortgage fraud, they can go to fraud tips at FHFA.gov. We will take in all of the requests and all of the submissions that people have. We've poured through many of these tips. We have seen just an insane amount of tips on mortgage fraud. Mortgage fraud is a huge issue in this country. So we get it from fraud tips at FHFA.gov. We get it through traditional other means, whether it be by mail or what have you. And also there's stuff in the media all the time as it relates to mortgage fraud. So we will take it from anywhere and everywhere. And again, our main focus is on the safety and soundness of the mortgage market.
Okay, that makes sense. So I guess my question to you, Bill, is was there some kind of tip-off to look into Lisa Cook's documentation specifically?
As I have said publicly, there was a tip that we received. I do not comment on the source, identity, or any other means that we use during a federal investigation as it pertains to things that are outside of the referral letter. You can imagine that if we start exposing, whether it be on this investigation or other investigations, where we receive tips from, where we get whistleblowers from, this is a very serious thing. And so when people are trying to, in my view, intimidate whistleblowers, intimidate tipsters, I strongly condemn that. And if people have mortgage fraud, I encourage them to go to fraud tips at FHFA.gov and send us those mortgage tips.
Bill, have you been looking into any other Fed officials or any other government officials on something like this? Have there been any tips to look into those?
Again, I'm not going to comment on any specific investigations other than the ones that either have been made public by other people or that we feel comfortable speaking to, and that pertains to things within the confines of the referral letter.
When we talk about that referral letter, and, you know, Bill, you've seen the pushback on this, and we should kind of point out here that part of the concern right now isn't so much whether she or anyone else out there committed fraud, but I think a lot of people would like to know whether there is more of a coordinated effort.
But that is the issue, because that is the issue, because you've been interviewing me now for 2 minutes and you keep asking me about all of these tangential issues instead of asking about, you know, did she sign these documents? I believe she did sign these documents.
Okay.
Is it mortgage fraud to say that you live in one area and not another area? Yes, it is mortgage fraud. So you're not focusing on the fraud. You're focusing on the investigators for purposes of trying to undermine what it is that she did, allegedly, and what it is that mortgage fraud and the risk that mortgage fraud poses to the system. Well, and we're not going to be intimidated. I mean, we swore an oath, and we are going to continue to prosecute mortgage fraud. It doesn't matter whether it's a Republican, a Democrat, a public official, or Joe Blow on the street.
Absolutely. And we are in agreement for that. But what we are doing here is we are actually focusing on both issues, both the potential for fraud, and we are digging deeper into that. And we should point out that Bloomberg has made concerted efforts to reach out to Lisa Cook and her representatives, to the Fed, as well as to folks in the White House and administration beyond you. At the same time, Bill, we also have raised concern about whether this might be a weaponization of your office, a weaponization of the White House. And I am curious if there has been direct, I don't know, guidance from the White House to pursue this?
We discovered this within the confines of our charter that Congress has given us. We continue to receive tips within the confines that Congress has given us. As I said, people can go and email us. They can send us tips. We encourage that to happen. And that's how this was sourced. And it's going to continue to be sourced. And, you know, just because now, you know, somebody said to me earlier today, they said, you know, mortgage fraud is being controversial by some people in the media because you've really hit on power. And that struck me because I'm like, you know, shouldn't power be against mortgage fraud? It just doesn't make sense to me now that you have somebody who's in this type of position and now it's controversial and maybe now mortgage fraud isn't mortgage fraud. I mean, you saw the Federal Reserve president from Kansas City. That was quite an odd exchange that he had about, you know, blaming the forms and stuff like that. Let's call it what it is. People have a responsibility. And people in power especially have a responsibility to read legal documents before they sign them.
Well, I mean, to that point here, I mean, there's been a lot of talk about a report that the Philadelphia Fed put out, I think back in 2023, specifically on this issue of owner occupancy fraud. Basically, the idea of putting on a mortgage application that you're going to use something at your primary residence and get a lower mortgage rate, which it seems to be at the heart of the documents that you posted with regards to Lisa Cook. It was a pretty high number, something like a third. And in that report, they specifically used the phrase that this type of practice is, quote, broad-based across the U.S. Now, that's back in 2023. I am curious as to what measures the authorities, either your agency or other agencies, can take to actually reduce that trend of owner occupancy discrepancies.
We are working very actively on it. I appreciate the question. If you look at my Twitter feed, if you look at my testimony, we have made mortgage fraud a huge priority since the beginning. I didn't know any of these people were committing mortgage fraud when I, came on the job. I mean, I had heard about, different public reports and stuff like that. But, the amount of referrals, I am shocked now that I'm in office with how much mortgage fraud has gone on. So we have taken, I saw today,
have you actually taken
on another
formal
network.
legal action?
Hold on, let me finish. I heard on another network, they said, well, can't you use AI to do this? That's
AI?
exactly what we did.
Okay.
We did months ago. We went and we partnered with Palantir at Fannie Mae. We held a massive press event. And we said, look, everybody beware. We are looking for mortgage fraud. We brought in Palantir. We have made tremendous efforts globally across the population, across the data set of loans from Fannie Mae.
Yeah.
And it's startling to me that because you have one Fed governor, you try to make an excuse for it instead of saying this is wrong and this is prosecuted every day of the week for other people.
How many referrals have you made for some sort of criminal investigation?
A lot. Sometimes I do multiple per day and certainly multiple per week. And my agency, along with the Inspector General in my agency, works hand in hand with the Department of Justice, has done it under the Biden administration, did it under the Obama administration, did it under the first Trump administration. Mortgage fraud is prosecuted every day in this country. And as long as I'm in this seat, we're going to continue to eradicate fraudsters wherever we find them.
So it sounds like mortgage fraud is, I don't want to say common, but it's not uncommon either. Do you think there's a plausible reason for your findings? People do move and they don't always have a chance to update paperwork, and so paperwork gets left behind or is out of date. Do you think that that's a possibility here?
I'm not sure I totally understand the question. I mean, as a general matter, I believe that occupancy fraud is wrong. I believe that when people sign a piece of paper and they go to a bank and they say that they represent to a bank that they're going to do something and then they do something different, I believe that that is bank fraud. I believe that that potentially is wire fraud. And I believe that that is, in the case of mortgages, often mortgage fraud. So, we have rules in this country. And I just say this, what is the point of laws if they're not going to be followed in this country? And if people don't like the laws that are on the books, well, then go and change the law. But if we have laws, and if I promised, which I did promise the Senate, to uphold the laws and follow the law and the statute, we have to follow the law and the statute, always.
Bill, I want to transition now to Fannie Mae and Freddie Mac and the possibility of an IPO of these government-sponsored entities. What assurances, well, first of all, can you give us an update on where things stand with this potential IPO?
Well, the president decided many years ago to not sell this asset. It was one of the best decisions that's ever been done, in my opinion, from the presidency as it relates to assets that the U.S. government has had. Why? Because people wanted to sell it to investors for $100 billion, $150 billion. I think that number is north of $500 billion now that these assets are worth. Since taking office, not just focusing on mortgage fraud and other systemic issues like safety and soundness mandates, like we just spent the last 10 minutes on, but is also focused on driving value and treating Fannie Mae and Freddie Mac as if they're businesses, taking cost out of these businesses that is redundant and unnecessary, and also making sure that we are always thinking about how do we, within the confines of the law and in the best interest of the American people, run these things as businesses. So if people aren't performing, we get rid of them. We don't keep them around for years and years and years and decades just because they're politically connected. And so I think that this has enabled the Fannie Mae and Freddie Mac story to really, with President Trump's help, unlock a lot of value for the American people, and it'll be very interesting to see what the president decides to do in this regard.
With regards, so I mean, I was looking at the video that you guys put out. I think it came through the White House's account about the Great American Mortgage Company. So basically, the combination of these two, also what does appear to be a rebranding of your agency and this U.S. financial technology segment, which I guess would sort of help with regards to the securitization. Now, is the idea all of that, Bill, would be under the same umbrella, and I assume that you would be at the helm?
Well, we'll see. I mean, these companies are in conservatorship, as you know, which basically means that the president is in charge of these companies. And there was a Supreme Court ruling which made that very clear. I would say that any and all options are on the table. One of the things that I've been focused on, Romaine, has been, since getting in this seat, is on creating value. Now, what the president ultimately decides to do with that value is entirely up to him. but we had a thing called Common Securitization Solutions. Nobody understood what this thing was, generally out there. And so we decided to rebrand it as U.S. FinTech and really focus on what it is, which is financial technology. I believe this business is worth billions and billions of dollars. It was previously neglected, in my view. Fannie Mae and Freddie Mac have put almost $1 billion into this platform. And so we're unlocking value there. And then with Fannie and Freddie, we'll see. We'll see if the name has changed. We'll see if these things are there. But we're trying to aspire to a new tomorrow. Fannie Mae and Freddie Mac were these once nearly bankrupt assets, or bankrupt assets, many people would say, and we're trying to revitalize those. These should be great American icons. We are the greatest economy in the world, and we have a great president, and we are going to use these assets to benefit the American people and get the most value out of these assets that we can.
Do you have any sense of a timetable of maybe when that will either get done, or at least we'll get a little bit more guidance, the public will get more guidance on when that will be done?
That'll entirely be up to the president. The only one who knows that is in his brain, and so I'll let him decide on timing, of course. But I would say that the president's very interested in this issue, and it's very nice to have a president who cares about Fannie Mae and Freddie Mac.
All right. We thank you. Federal Housing Finance Agency Director Bill Pulte joining us. And reminder that we are once again out to Fed Governor Lisa Cook for comment, and so far she has declined our requests for an interview. We'll keep you posted on further developments. All right, let's keep our focus here on Washington and get some reaction now to that conversation we just had with Mario Parker. He is managing editor of Economy and Government with Bloomberg News, and Mario joins us now from Washington. Mario, your thoughts on what Bill Pulte was just telling us with regards to Fed Governor Lisa Cook?
No, I mean, to your point, it was a very Pulte obviously outlined the rationale that FHFA has had for submitting the the referral over to DOJ. To be clear, a couple of things, as you all have noted, Lisa Cook has come out and in some ways pushed back against the assertion. Again, to be fair, and I know you also said that we're out to her as well, but also there's also the part and parcel of Adam Schiff, Tish James, and others also having this type of investigation by FHFA as well, who are political, either opponents of the president or have been perceived as impediments for the president as well. In the case of Fed Governor Lisa Cook, obviously the backdrop of all of this is whether or not her removal would give the president another seat on the Federal Reserve.
And that seems to be the undercurrent here. But before we get to that, though, Mario, I just want to clarify a couple of things, and we couldn't really get it out of Kaplan here. But when we talk about the documents that Bloomberg actually obtained and that later Bill Pulte himself made public on his own social media feed, we were talking about two mortgages. Effectively, at least they closed basically about a month apart in 2021. One was for some sort of property in Ann Arbor, Michigan, where she was a professor. The other was for some property in Georgia, where she had a residence for some time. Based on what we know, both of those documents, she listed both of those properties as her primary residence. Is that true?
From what we understand, that's based off of what's outlined in the letter. That's true. Again, Lisa Cook's her rebuttal to all of this didn't outright deny that this had taken place. I want to be as clear as possible here. It didn't outright deny. It just said that essentially she wasn't going to respond to something that she found out about on Twitter. She's going to look into it, these questions, et cetera, et cetera. Now, and you all brought this up, Romaine, during the interview. Some of this practice, again, if this was something that took place, the Federal Reserve of Philadelphia itself ran in a research report a few years ago, in 2023 to be exact, which found this to be relatively broad-based across the mortgage space. Now, whether or not this has legs, whether or not this goes to criminal prosecution, whether or not something does blossom out of all of this, one of the things that the normal course or the more frequent or routine course here is is in terms of mortgage fraud, when you think of that subject, isn't necessarily the dual occupancy that the Chair Director Pulte outlined. A lot of times when you think about this issue, it's inflating your someone's personal wealth, inflating the value of the property, those type of things that really add to losses for banks.
All right, Mario Parker, he is the managing editor for our economic and government coverage down there in Washington. Obviously, a big developing story there with a lot of undertones, particularly given the start of the Jackson Hole Symposium in Wyoming, where we are expected to hear from several Fed officials. We heard from the Kansas City Fed chair earlier today, and we're going to hear from Jay Powell, the chair of the Federal Reserve, tomorrow. Our next guest used to be on the Fed. He used to head the Dallas Fed, and he says that investors should actually be watching for two things out of this meeting: any potential foreshadowing for the FOMC's pivotal September meeting, and any commentary around the Fed's framework, particularly as it relates to central banks' independence. Pleased to say joining us right now is Robert Kaplan, former Dallas Fed president and now vice chairman over at Goldman Sachs. Thanks for joining us here today, Robert. And of course, before I ask you specifically about Jay Powell and what we're going to learn out of Jackson Hole, I do have to ask you about some of the allegations surrounding Lisa Cook, the political undertones that some people think that there is a concerted effort to try to reshape the Fed board. And of course, the general idea here of what Fed independence even means in this current environment.
Yeah, so I've obviously read the reports. I don't have anything to comment on there. I do think the main thing is it's critical for members of the Fed to do their work without regard to political considerations or political influence and come to the best judgments they can. And I'm hopeful that will continue to be the case.
I am curious about just the general process here, because, I mean, there are a lot of allegations that we know so little publicly. There has to be an investigation both by the Fed internally and it looks like at this point maybe potentially by the DOJ. But you were the subject of allegations several years ago when it came to trading. You decided to step down, in your words, to avoid that distraction. Only, what was it, maybe about 3 years later, to have the Fed come out and say, after doing an investigation, they found you actually did nothing wrong. Do you regret stepping down when you did?
No, I made the best decision that I thought was the best interest of the institution. But I think I'm sympathetic. The situation that you're currently talking about has its own set of facts, and I don't want to comment or say anything about it. I think the people involved will do the best they can to deal with it, and I think I'll leave it at that.
Thank you for sharing that, Robert. If you believe that President Trump is trying to secure a majority of the Federal Reserve Board, the 7-member board, what would that really accomplish? And I ask that, Robert, because we know that the FOMC is more than just the board itself, right? You have Fed presidents who also vote on the FOMC.
There are 12 votes in every meeting. And they're the governors as well as 5 of the presidents. And no one person makes the decision. The chair doesn't make the decision. He or she has to form a consensus around the table. And I think you've got an ethic at the Fed, which is very strong, of looking at all the available analysis, talking to businesses, understanding all the structural drivers in the economy, and trying to come to the very best judgment that you can, and then bring that to the meeting and debate it out. And I think it's a healthy process, and I'm very hopeful that that's the process that will continue.
And of course, one of the things everyone will be debating about is what the economic data show about the state of the economy and what's in store for the economy. As a former Fed official, as a former voting member of the FOMC, how would you interpret the data that we've seen the last 2 weeks, which includes consumer and wholesale inflation seemingly at odds? You have rising jobless claims. You now have a rebound in manufacturing, at least according to surveys.
Yeah, so here's the challenge for the Fed. On the one hand, we have a relatively sluggish jobs market and relatively sluggish GDP growth. We're at full employment, but the reason we're at full employment is because labor supply has been decelerating. Hiring has been very sluggish. And so I think the Fed probably would like not to see a further weakening in the labor market. That's on the one hand. On the other hand, we're running inflation above target. we've been running inflation above target for the last 3 or 4 years. It's been primarily services. This is before we even talk about tariffs. Goods, ironically, have been disinflating. We'll have to understand how the tariffs flow through goods. And what the Fed is trying to balance is, I think if the job market were stronger, I think it would be clearer to be patient and wait to see how the inflation is going to unfold and be more patient to see it trend further down toward target. But I think with this weakening in the labor market, it's going to push the Fed, I think, to be more forward-leaning and maybe do an adjustment in September. But the caution I would give, if they do move in September, I don't think that's the start of a cycle. I think it's an individual decision. Then they'll wipe the slate clean and take the next 6 weeks, try to understand these cross currents again. And so I think they'll shorten up the time frame and take it one meeting at a time.
I am curious as to what you think that debate's going to be like. We got the FOMC minutes from the last meeting, and there was clear division there as to what the Fed should do and when they should start doing it, if at all. And I assume that's going to intensify by the time we get to mid-September, now that we've had some additional economic data. Having been in that room and knowing how those debates go out, does that debate, is that going to center around, in your view, much more on the inflation side, or do you think it's going to lean a little bit more on the labor market side of the mandate?
So while there's a lot of focus on Jay Powell's speech tomorrow, the reality is we're going to get at least one more inflation print, and we're going to get the jobs numbers for August. And so that jobs number for August is going to be very telling and will shape the debate. But you're either going to see a jobs number that shows a further weakening or continued sluggishness. I think that would tilt toward taking some action in the September meeting, or you may see something stronger. But the debate is going to be about the fact that we are at risk of not meeting either side of our dual mandate. Mm-hmm. We're already above target on inflation, and how serious is the threat that the job market is going to weaken further. That's what they're going to debate. And the reason there's a disagreement is for good reason. It's not clear. And I think the fact that there's debate and disagreement, I think, is a good thing. I think there ought to be where there's these type of cross currents. So I think that's a good thing that they'll be disagreeing and debating.
When it comes to where the inflation rate or where the inflation target should be, there's been a lot of talk about 2%, or I guess now it's 2%-ish. But the idea that the economy has been running relatively okay with at least headline inflation in the 3% range, core inflation in the high 2s, is there an argument to be made, Rob, that longer term, maybe we can live with a higher target rate, a higher neutral rate?
Yeah, I would argue against that, and here's why. There are approximately 80 million workers in this country that make $50,000 or $55,000 a year or less. They've lost 25% plus purchasing power over the last 3 or 4 years. They are struggling to make ends meet. If headline inflation is 3, headline inflation for them based on share of wallet might be 5 or 6 or 7. And so I actually think it's very critical, particularly for low, moderate income workers, that the Fed continue to work on getting the headline inflation rate down to 2 and not be satisfied with 3.
Rob, I got to get your sense as well about what we've learned from companies this earnings season, particularly of late with the retailers reporting results. We already know Nike, Sonos, P&G have been mulling raising prices. Walmart said as much as well, that it would have to at some point start raising prices in the second half of the year. Ditto for Home Depot as well. So how do you fold that into the thinking of inflation as we anticipate higher prices due to higher costs from presumably the tariffs?
So there are 4 areas that are going to impact on the tariffs. One is, we've got a world of manufacturing overcapacity, which tells you that companies here that are buying from overseas may have more leverage over suppliers. The dollar, although it's weakened this year, the dollar could strengthen. That'll take a bite out of the tariffs. Companies may take some of that out of margin, and yes, they may put some in prices. But you got to remember, the consumer has the ability to substitute. They can be very price sensitive. About 25% of the U.S. economy is goods. 75% is services. Consumers can decide not to buy a good, and they can decide to go out to dinner or do something else instead. And so to the extent companies can pass on tariffs to consumers is going to depend a lot on their pricing power, how strong demand is. And so there's a lot of these things that companies I talk to still are uncertain about. They're feeling their way. They'll figure it out and they'll make it work. Where I'm more concerned is small businesses I talk to who don't have these levers to pull. And I think for them, for many, they're actively debating whether they can make it through the end of the year because they don't have the flexibility to manage tariffs the way big companies do.
Yeah, they don't have as many options, and I really appreciate you bringing that up. I mean, all of that adds up to a very complicated economic picture where the economic indicators that we rely on and debate over don't always capture the cross currents and the nuances that are taking place underneath. All this anecdotal insight from companies, particularly small companies, as you put it, around the country is incredibly valuable. So, and all of that is encapsulated in something called the Beige Book. Do you feel like the Beige Book should be more valuable to the FOMC than it has been up to this point? I mean, I know that as a reporter, we sometimes get the Beige Book and we kind of look at it and say, oh, that's backwards looking. It didn't really tell us anything.
Yeah, the Beige Book for me is a critical part of the process. There's a whole mosaic of things you look at. You talk to businesses, you look at data that is published, you look at the Beige Book, you try to understand structural drivers and macro factors. But the Beige Book is very valuable. It's one of the unique things that the Fed is set up to do because it is distributed all over the United States and has relationships locally, and we get these survey results. It's very informative, but it's a piece of the puzzle that's very helpful. In periods like this, where you have a number of structural changes going on, I think being closer to business, that includes the Beige Book, it can be talking to businesses. I think that becomes more important because the data, again, is backward looking, it's aggregated, it may be lagging, it gets revised. And so I think you have to look at the whole picture.
And that's a good point. And I think a lot of people in the market have been trying to do that even prior to some of the recent developments. And it gets to this idea as to whether you see any opportunity to actually improve the government, the official government data, the collection of that data, the timeliness of that data, and more importantly, the accuracy of that data. I mean, what can we do to actually update that?
Well, so there's been a lot of discussion. I think I've mentioned you before. I remember I learned when I first got to the Fed, the first piece of advice I got is don't over-rely on any one data print. It tends to be backward looking, it's aggregated, it's going to get revised. And so I think we also are aware of post-COVID, the survey response rates have declined. So I think in this world of AI, high-frequency data, a lot of private sources as well as public sources, use of technology. I think the BLS will be well served, and I'm confident they will do this, to look at how to upgrade the accuracy of their data. Even with that, I would say the data is never going to be perfect, and I think you're always better off looking at the 3 to 6 month trend, not overreacting to any one data print. And I think that ethic is always worth a reminder when you're at the Fed.
I am curious. I mean, you sit in a very unique position, having, of course, worked in the government at the Fed and obviously a long career on Wall Street and now back there as vice chairman of Goldman Sachs. There is the idea that we have to be, as a market, and I say the we, royal we, not necessarily relying on that data, but at least have some faith in it, in the data, faith in the independence of the Fed, faith in the reliability of U.S. government economic data. That faith is being tested right now, and I'm curious if that worries you at all.
It's always a concern. It should be a concern. However, this is where I used to teach leadership, as you may know, at Harvard Business School for 10 years. This is where people matter. It's up to the people involved to adhere to an ethic that they're going to make decisions based on their best available information, without regard to political influence or political consideration. That ethic is very strong today at the Fed, and I am very hopeful that that ethic will continue, and it'll be up to the leaders of the Fed to make sure of that.
All right. Thank you so much. Rob Kaplan is the former Dallas Fed president and, of course, current vice chair of Goldman Sachs. And, of course, coming up later on Bloomberg Television, Balance of Power will be sitting down with the current Chicago Fed president, Austin Goolsbee. All right, coming up, we are counting you down to the closing bell. Next up, we have the CIO of Global Asset Allocation with Northern Trust Asset Management talking to us on the eve of Jay Powell's big speech. Romain, there's some talk about inflation, labor market. We're all taking bets on what he's going to say.
Maybe he'll say nothing.
Unlikely. This is The Close on Bloomberg.
When we specifically talk about the small cap versus large cap trade and growth versus momentum, I'm a little bit still in the camp, Romain, of boy who cried small cap. In just that I've seen this movie so many times, it always kind of precedes this potentiality of having a rate cut. We never see it come to fruition.
Taking a look at the markets, we're talking about a NASDAQ 100 down for, what is this? I believe now the sixth day, or actually, well, Tim Senovic, of course, is a truther because, it was basically unchanged on Monday.
Yeah, so you got to take that into account.
5 of the past 6 days. But I do want to point out, this is really the only day that they've actually spent any time really in the green, not much time, but now back in the red, down 0.4%.
Yeah, and for the S&P 500, it's a pretty clear fifth straight lower as well. And what's notable, I suppose, is that the VIX has been edging higher. It's now at a 2-week high. Still pretty low, but, keeping an eye on that, especially before this high-stakes speech tomorrow. Yeah,
I've been trying to figure out, too, we talked a lot yesterday about that this is more of a technical-driven sell-off. It really wasn't about fundamentals, and there was a lot of seasonality that is, playing into some of the outsized moves. But it also gets to the idea that this is a market that, at least for right now, does not appear to be even trying to push stocks to the upside. We're not necessarily getting a big sell-off, but there's no one really coming in. You're not seeing that aggressive dip buying that has led to these big snapbacks like we had in the past.
It's absent for sure. Yeah. And, again, it all depends on how the Jay Powell speech goes tomorrow. So for more analysis, let's welcome now Anwiti Bahuguna. She is CIO of Global Asset Allocation with Northern Trust Asset Management. Anwiti, how do you read what we're seeing in the equity market? Is this just bored traders in late August positioning before a high-stakes speech, or is there something more to this 5-day retreat in the S&P 500 with, sky-high valuations in some of the biggest cap stocks?
Hi, Scarlett. Thank you for having me. I think summer is a factor. It is the last 2 weeks of summer, and liquidity does slow down a little bit. But we do have an important event tomorrow at Jackson Hole. So that's keeping folks a little cautious this week about their positioning. I'll also point out, stepping back from just the last 2 weeks or so, if you look at it from Liberation Day month, the month of April, stocks have been on a one-way street up nearly 25% or more since the end of April or so. So this has been a very strong run. And to your point, valuations look stretched. People are concerned about what the Fed might say tomorrow, and that may be the reason for the near-term volatility that you're seeing in stocks.
If we don't get a binary outcome from the speech tomorrow, where Jay Powell either hints that there is a rate cut coming in September or not, what happens next? What's the path of least resistance right now?
So it's quite unlikely that Jay Powell will be that clear to us on whether there is a rate cut in September or not. Most likely they will repeat their assessment of the current economic environment, which in their mind, Scarlett, it had been fairly straightforward that they were worried about inflation risks. And incidentally, we're worried about inflation risks, but they were not all that concerned about their second mandate, which is the labor market. The labor market was actually quite healthy until the last labor market report, where we saw the weakness starting to creep up. So at this time, markets really interested in knowing what is their assessment of the current economic environment. Are they going to focus on the fact that we still haven't fully seen the impact of trade and tariffs on inflation? Or are they going to talk a little bit more about what's happening in the labor market? And that might lead to some clues about what may September hold. But there's still a lot of data to come in between now and September. So I suspect they're not going to very openly talk about what September might hold for us.
I am curious, when you think about what you just said with regards to the Fed and the economic backdrop, all the politics, all the tariffs, and of course the earnings season that we just got through, do you still look at U.S. equities as being something that you would overweight to a global portfolio?
That's a very good question, Romain. And actually, we have not overweight U.S. equities in a global policy portfolio. We are neutral global U.S. equities. Part of it is the concern around actually what's happening in the economy, with the economy slowing down and inflation still very high. In our assessment, this is not a great time to take a lot of risk in the U.S. equity portion of your portfolios. Instead, we actually like develop ex-U.S. right now, and we actually also like TIPS a lot. Northern Trust just launched 4 TIPS portfolios of different duration to handle TIPS exposure in our client portfolios. And on the equity side, we're focusing on more defensive equities because it's not clear to me that we can maintain this valuation level with the economic risks we see forthcoming.
I'm sorry, on the TIPS thing, that kind of threw me. So, I mean, I would assume you would not have that type of stance on TIPS unless you expected some sort of sustained increase in inflation, or at least some maintaining of where we are with current inflation levels?
So inflation is a worry for us. We have not seen evidence yet that we are out in the clear on the inflation front, Romain. You saw inflation being high in the PPI report 2 weeks ago. CPI report broadly was below consensus. But when you parse through the details of the CPI report, you saw that inflation's beginning to creep up in the one portion of CPI where inflation had been actually quite benign, and which is the services component. So we're seeing services inflation get stickier. We expect good inflations to ramp up with the trade, with the tariffs. And so this is not an environment where we think all's clear on the inflation front.
What would you need to see to be more comfortable taking on extra risk, additional risk at this point?
So I think that's a great question. I think what we would like to see really is the labor market picture stabilize and some clarity on where monetary policy might be. Is the Fed going to look through this inflation episode, which is still to fully manifest itself? Or are they going to start cutting the rate cycle because the labor market is worrying them more? So clarity on the Fed stance would be very important to us. We're continuing to see good earnings, Scarlett, actually, on the S&P 500. So I want to make sure that I convey the message that we are not underweight U.S. equities. Also, the AI story is still very much front and center, and we are participating in it.
All right, Anwiti Bahuguna, CIO of Global Asset Allocation over at Northern Trust Asset Management. And of course, on the AI front, we are going to hear, of course, from the granddaddy of the AI trade, NVIDIA, in about 1 week's time.
Yeah, so speaking of catalysts for the market, right? And after that, we've got the non-farm payrolls in early September. It's never too early to look ahead. Right now, the consensus is for 83,000 jobs added after 73,000 the previous month, which was a huge disappointment given what people were anticipating.
And of course, the other big trade has been involving retail, at least the consumer sector. Those earnings out of Walmart today, the profitability not great, but believe it or not, the revenue side was actually decent. We're going to get a report after the bell from the off-price retailer Ross Stores. A full breakdown of all of today's market action and a push to all of those earnings starts right now.
The Closing Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close, starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romain Bostic here with Scarlett Fu, taking you through to that closing bell with the global simulcast. Tim Senovic joins us from the radio booth. Nora Melinda in for Carol Massar today. Welcome to our audiences across all of our Bloomberg platforms, including our partnership with YouTube, as we parse all of the big moves going on across all of the markets, from stocks to bonds to currencies, even to tungsten.
Tungsten, I'm glad you were listening to that interview. It's not necessarily considered a rare earth, but it's certainly one that's important to the supply chain. Thanks for listening and watching.
Tim and I were trying to
earlier.
You are my third
Tim and I were
favorite show on
trying
this network.
We were trying to count how many times the word tungsten was used in that interview. Lots to talk about today.
How are we even not talking about the Fed chair's speech tomorrow? Because once he's done with that, we're going to be talking about NVIDIA earnings next Wednesday.
Or we could go back to tungsten.
Yeah, we could.
We could.
Well, I mean, it gets the idea, though, with that speech. I mean, you do have a market that has pretty much convinced himself that not only are we getting a rate cut in September, but this is going to be the start of a dovish cycle. But we spoke with the former Dallas Fed President Robert Kaplan, now vice chair at Goldman Sachs, who basically said he thinks that we're going to get a cut in September, but he said that's not going to be the start of a rate cutting cycle, primarily because the data is just not going to support it.
Which data specifically?
Well, he talked a lot about labor market conditions, but also the idea that we're starting to see inflation bubble back up. You saw the PMI data today, Tim and Nora. I mean, what'd you think of that? I mean, the price pressures are still there.
Yeah, I think that's fair to say. And we got the minutes yesterday, and I think it's fair to say, okay, how would the conversation at the Federal Reserve at its most recent meeting shifted had we gotten the hotter than expected PPI, the hotter than expected wage numbers? So, yeah, I guess it's fair to say.
Thank you. I appreciate the compliment. We get the closing bells here in New York on this Thursday afternoon. Red across the screen for most of the major indices here in the United States, but we should point out all of them are well off their lows of the day. The Dow Jones Industrial Average down more than 100 points or 0.3%. The S&P down about 26 points or 0.4%. The NASDAQ Composite is going to close out the day down about 0.3%. Similar story for the NASDAQ 100, which is down about 0.5%. And we should point out that's now a sixth straight day of declines. And that, yes, that includes Monday, Tim Stenovic. And then Russell 2000, that's the outlier on the day. It spent a lot of time oscillating between gains and losses, but managed now to finish out the day in the green, up 0.2%.
All right, we do have some earnings. It's still earnings season after all, and this is not from the retail sector. It's from the software sector. This is Intuit, which of course does own tax preparation software companies. Intuit reporting fourth quarter adjusted EPS of $2.75, beating the consensus estimate of $2.66. Net revenue was also higher than anticipated, $3.83 billion. When it comes to the outlook, Intuit sees revenue for this full year, 2026 revenue, I should say, $21 billion to $21.19 billion. Analysts were looking for $21.08 billion. Adjusted operating income anywhere from $8.61 billion to $8.69 billion. Analysts were looking for $8.67 billion, and you could see the stock moving lower in after-hours trading as its adjusted EPS also comes in at $22.98 to $23.18. Analysts were looking for $22.99. So it does appear that adjusted operating income and perhaps that revenue is the number that is concerning some investors.
All right, you see the shares there unchanged. Meanwhile, more activity right now in Ross Stores. That company just now reporting earnings. The comp sales in the most recent quarter did come in at about 2%. Now, that's relatively in line with what the street was looking for, though we should point out that growth rate is about half of what it was from the year ago period. Now, on the EPS side, it came in at $1.56. The street was looking for $1.53. So that is also a beat as well. And merchandise inventories, though, did rise to about 4.7%, relatively in line with estimates. Here's the forecast. The company says that for the full year, it sees EPS in the range of $6.08 a share to $6.21 a share. The top end of that range is below the average of analyst estimates. Analysts were looking for about $6.24. That might be why you're seeing the knee-jerk reaction with the shares moving to the downside.
Okay, Ross down 3% in the after hours, up 3%. Workday, the HR cloud management software firm. The company out with some news in addition to numbers. Second quarter adjusted earnings per share coming in above estimates. Second quarter revenue coming in ever so slightly above estimates. We'll go ahead and say that actually just matches estimates. The news here, though, is that the company says it signed a definitive agreement to acquire Paradox, which it calls the AI company redefining the frontline candidate experience. I'm reading from the statement right here.
What does that mean in English?
It's a definitive agreement to acquire Paradox. It's an agent that uses conversational AI to simplify every step of the job application journey, particularly for high-volume frontline industries, which employ nearly 3 billion workers globally. Workday says the addition of Paradox will give it an AI-powered talent acquisition suite to help customers more efficiently find, hire, and onboard every type of worker. So I guess the idea is that it makes the onboarding experience easier for those folks who use Workday software, but I'm going to have to dig into this acquisition a little more later.
That sounds about right, and makes it more efficient for the company as well after they spend the money to buy this company. All right, let's just take a look at what happened in trading when it comes to the sector performances, because a down day overall here, unlike previous days where there were more advancing sectors than declining sectors, even as the S&P 500 declined, this was an overwhelmingly negative day here among the sectors. Only energy and materials, and these are some of the smaller sectors, as you can see by the thin slices of the pie, gained. Everything else declined, led by consumer staples, and that, of course, was being dragged down by Walmart.
Okay, well, let's go to some of the gainers. Tough to find them, but the best performer in the S&P 500, up more than 14.5%, was Paramount Skydance. Remember the new ticker, PSKY? higher all day, even after some news that two House Democrats, Jamie Raskin and Frank Pallone, will examine whether Paramount Global and Skydance Media accepted, quote, illegitimate demands from President Trump to secure approval of their merger last month. Paramount Skydance did not immediately respond to requests for comment. The White House and the FCC also did not immediately respond to requests for comments. SelectQuote surged today. This was among the most actively traded stocks, up more than 41%. It's the insurance company. This jumping the most intraday since February after the company reported positive adjusted EBITDA in the first quarter. Wall Street expected a loss. Those numbers coming ahead of the bell. And the most actively traded stock in the entire index or in the entire market today, by far, Open Door Technologies.
Oh.
Yeah, surging again, another 11% higher today. I know.
Did they report earnings or something?
No, nothing happened. Except we are speaking with Eric Jackson of EMJ Capital a little later in our program. He's the, well, it's a small hedge fund that he has. He's the only employee, and he's been all over social media with this company, and he's been able to, I think it's fair to say, get the conversation started with retail investors about where he thinks this company's going, and they've been responsive.
Sweet.
Let me just jump in here because Zoom just reported results. Zoom's second quarter adjusted EPS of $1.53 does top the consensus estimate of $1.38. Second quarter revenue, $1.22 billion, a slight beat on the expected $1.2 billion. In terms of the outlook, it sees full year revenue of anywhere from $4.83 to $4.84 billion. Previously, it saw $4.8 to $4.81 billion, so that is an upgrade in its outlook for the full year. In terms of the full year operating income, $1.91 billion to $1.92 billion, also an upgrade from what it had previously anticipated. Full year free cash flow will be at least $1.74 billion, whereas previously it saw at most $1.72 billion. That stock moving higher in the after hours trade by 4.4%.
Well, let's look at some of the stocks that are in the red today. Of course, we know the market was lower at the close here, but let's take a look at Walmart shares. This is the second biggest decliner in the S&P 500, and this is after the retailer reported a profit that missed expectations for the first time in 3 years. This did overshadow the higher sales that it did report, and of course, we know we've gotten so much from a lot of these consumer-oriented companies, and it does seem to be a bit more of a dismal story right now. I mean, Morgan Stanley analysts are saying that there's a lot of noise and profitability specifically here for Walmart, and they expect the underwhelming earnings won't be a long-term risk to the stock. So that is something, of course, to note. We see shares that are up about 8% year to date here. But I do also want to take a look at Coty. And of course, this is the owner of a lot of the brands that we know, from Gucci to CoverGirl to Adidas, Calvin Klein. Shares are down 22% at the close today. That is the worst daily performance that we've seen since COVID, March 2020 here. And this is after the company reported essentially forecasting steep sales declines. Their forecast was not clearly accepted well by the market here. They're talking about innovation fatigue, specifically with this cosmetics unit here. So lots to really parse as we look at the earnings here. But I mean, if you look on a broader scope, it's a pretty brutal year here for the company. Shares are down 45% year to date. But let's end things with Cracker Barrel. Of course, we know this is a company that's been
I'm really into
in
the story.
focus.
Explain it to me, because I'm very confused.
So much chatter online, right? I mean, everyone's talking about this company right now.
Why?
So we saw a slide in shares today, and that's after the company decided to change its logo. So if you're familiar with the company, their logo has always featured a man sitting on a one of those little, what do they call them, a barrel?
Yeah, it's a rocking chair.
Yeah, a little rocking chair moment.
Shoulder.
We're removing that now.
Elbow perched on. And that sent the stock down?
Yeah, so we're moving on. People were really attached to this logo.
I don't get it.
I'm not to be pedantic, but I mean, this has somehow become a political culture war issue, and I honestly do not understand it. So explain it to me.
Have you guys been to Cracker Barrel?
Yes.
Okay, so you're familiar when you walk in, you know, the vibe, the energy.
I mean, look, if you want to reminisce about the antebellum South, it's a great place to go.
We have a bunch of them back in Virginia, so I'm definitely very familiar with the restaurant. But seems as though people are not really happy about this shift that they're seeing here.
Part of it is because the CEO who made the decision here is a woman, so that is fanning some outrage in some circles. I'm sure online. There's always an online circle.
In all seriousness, though, it does get to this idea of just, and I mean, you were pointing out Open Door, and of course, a stock that has seemingly rallied for no real particular reason. It gets to the idea of why certain things are getting bought and sold, not for any real fundamental reason, but because they've either become political footballs, either in a good way, or in this case with Cracker Barrel, on a bad way, and just kind of who actually is driving this trade.
Right. Yeah. Well, Michael Halen over at our Bloomberg Intelligence team, he has a note out that really says, don't read into this stock decline too much. And the idea that this will affect the brand in a way that, let's say, an Anheuser-Busch was affected with what happened in the last couple of years in politics there with the ad campaign a few years ago. It's not going to be like that.
Yeah, but the volume in today's trade was 4.5 times the 3-month average. Right. So I don't think we want to read too much into it, but there's a lot of people trading it.
It reminds me all that we were seeing with the retail trading meme stock mania the most recent weeks.
I guess we got to go, but we could talk about Cracker Barrel all day.
That
is going to do it.
Let's find some people who really love barrels and get their opinions on that.
Coverage of the market close.
Are the
Join us tomorrow,
in the barrel?
Same time, same place. It'll be Friday, and we'll have heard from Jay Powell.
And our coverage continues here on Bloomberg Television with a closer look at rates and Jay Powell, a closer look at the health of the consumer with those earnings by Ross Stores that just crossed the wire a little while ago. This is The Close on Bloomberg.
The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
Welcome back to The Close. A more than week-long sell-off that we've been seeing in markets continued on the day. It was a relatively modest pullback on the day, but when you add it all up, the trend line has been certainly to the downside. 0.4% lower in the S&P 500, but pay attention to the NASDAQ 100. It's basically been weak now for the last 6 sessions, and you're starting to see it test not only that 20-day moving average, but now putting the 50-day moving average in play as well. Now, some people are taking a look at this and saying that the pullback is not fundamental. It's much more of a technical-driven rally, one that could actually shift as we get out of August and into September after Labor Day. You see the VIX did perk up on the day, and some of the more riskier assets, riskier corners of the market like Bitcoin pulling back as well. As far as the idiosyncratic stories, one of the bright spots on the day was Packaging Corp, second biggest mover in the S&P 500, and this had to do with International Paper, the biggest player in that space, saying it was going to reduce its U.S. containerboard capacity. Based on some calculations Bloomberg did, they are anticipating the capacity in the United States could be down about 9% this year. That puts upward pressure on the prices that companies like Packaging Corp can actually provide. Walmart, that was one of the biggest decliners that we saw in the S&P today, and that is a big part of the story all week long. The idea of the health of the consumer. Hovadian Enterprises, a big home builder, said they're seeing a stagnant housing market, just not a lot of buyers out there. And of course, we were talking a little bit earlier about the political football that Cracker Barrel has become. And that brings us to our top story of the day, and quite frankly, what's been our top story of the week, and that's the check on the health of the consumer. We got that big check with Walmart this morning, the world's largest retailer, posting an almost 5% jump in second quarter sales and raising its guidance for how the rest of the year will shake out. Now, those results on the sales side really do reinforce recent economic data, which shows that retail sales have held up this summer, supported by what is still a relatively stable job market. However, there is evidence that many shoppers are starting to curtail big ticket purchases and even some of the smaller ticket discretionary buys like clothing and home products. Now, for Walmart, that might actually be a good thing, because despite inflation rates of more than 3%, Walmart actually nudged up its prices by only 1% on average in the most recent quarter and has been employing promotional campaigns such as that week-long deal event they had back in July. Other retailers with value-oriented business models are also seeing benefit. TJX, it reported yesterday, and compared to Target, well, it was really indicative of that trend. And just a few moments ago, we got results from the off-price retailer Ross Stores, which grew sales last quarter on the back of what were lower than normal discounts of higher-end brands like Calvin Klein, Kate Spade, and Karl Lagerfeld, reinforcing the idea that, well, if you are looking to maybe save a little bit money and still be stylish, there are options out there for you as a consumer, and maybe Ross Stores might be one of them. Laura Champine joins us right now, Director of Research and Consumer Sector Head over at Tabor Asset Management. And I know you had a chance to kind of look at these numbers. I mean, they were decent. I mean, for all of the hand-wringing I think people have had about the health of the consumer, we continue to see certain pockets of the retail space, particularly off-price space, doing well.
Right, and we like everything that's value-oriented. What struck us about these results, inline sales for this quarter, but the guide for the back half was actually pretty strong. Ross got rid of its guidance last quarter, came back to it, and the earnings guidance is pretty much the same. Sales guidance is much better. That plus the good sales results out of Walmart tells us that the themes that we're playing, which is that companies with scale will win, companies that provide value to the consumer will win, that seems to be playing out.
And just for our viewers, that comp sales sales estimate they gave. The previous one was like in the 2 to 3%. 2 to 3% is what they're guiding to, and their prior was something like 2.25.
Their prior guide for the full year was down 1 to up 2. Okay. So up 2 to 3 is a little bit better.
So that is a significant improvement, because when we kind of read those numbers, it looked like they were kind of trailing analyst estimates, but this does look like a little bit of a reset higher in their view of where things are going. What do you think gives them that confidence? Is it about economic conditions overall being beneficial, or is it about the idea that if economic conditions weaken, that it drives more traffic to them?
There's a little bit of both going on. So there is a trade down, but also we think customers across the board, when we do think there'll be more inflation as we go through the year, we think they'll migrate to value-oriented retailers, and you can see that. So there's an uptick in sales momentum in July and early in August, and a lot of our companies have been saying that. So I think so far the price increases from the tariffs haven't been that extreme, and there are places like a Ross, like a TJX, like a Walmart where you can find a deal.
Is there a concern, though, as we get deeper into the year, that these retailers will see a bigger impact from tariffs, and for some of them, at least the ones that aren't named Walmart, might not have any choice but to raise their prices for consumers?
Absolutely, which is going to be good for the big guys like Walmart. So we would stay away from small retailers. We think there might be some store closures coming out of this. We've already heard of them with mom and pops, really. It's a good time to be big, and it's a good time to have sharp prices.
When it comes to what consumers want themselves, I mean, I know obviously we all look for value and things, but there's also this idea of selection. I know everyone lauds TJ Maxx because the idea is not only is it relatively cheap, but you find really high-end brands there, not just in clothing, but in housewares as well. Is that the formula, or do you think maybe a specialty apparel retailer that maybe just has one singular focus but manages to keep its prices low can also compete?
You know, we like some retailers where their prices aren't low, but they have pricing power. So if fashion is right, we like Aritzia, which has been growing like a weed. Yeah. We like Urban Outfitters, mostly because of Nuuly that's growing, Anthropologie that's growing. There are still some retailers that have pricing power. Ralph Lauren we like. Coach is still doing a good job keeping price points high. There are going to be fewer and fewer promotions, so you either have to be really fashionable and have a hot brand, or you have to provide value. Those are your two choices this year.
With regards to how you reach the consumer, I mean, Walmart obviously has one of the bigger and more better sort of omni-channel business models. But then when I look at Ross Stores, which seems much more heavily weighted towards its brick and mortar stores, even similar for TJ Maxx as well, why are they kind of defying this idea that you have to have a big internet e-commerce presence?
You know, the apparel retailers like a Ross, a TJX, most of their customers are buying at need. So when the weather changes, they'll see people come in, buy right away. You need to try it on. Walmart said they're gaining market share mostly with the high-end customer. I think that customer is shopping online. Their online growth was twice what Amazon's was this quarter. So I think that's a customer who doesn't want to come into the store, whereas in apparel, you do have that kind of fashion hunt. People want to try it on. Makes a little more sense to get there personally.
And just real quickly, any concerns about inventory issues going forward?
Not at these few retailers. I mean, that's something we watch. I'm a little bit more worried about that in home-related, where we're still seeing demand very weak. You know, hopefully we get a rebound, but it may not be this year. In apparel, it seems like most of them have been pretty tight on their buys.
All right, Laura Champine there, one of the best in the business, Director of Research and Consumer Sector Head at Tabor Asset Management. A quick breakdown of those results we got out of Ross Stores this afternoon, Walmart earlier this morning, and of course we head into next week with more retail earnings, including from some of the department stores. When we come back, we're going to shift to the tech sector. Of course, there's been a big reality check this week when it comes to market valuations there. Sarah Kunst over at Cleo Capital, she's going to give us her take when we come back here on The Close on Bloomberg. All right, keeping an eye on the NASDAQ 100. It's been soft for a sixth straight day here, now down about 3% since it hit that last record high back on August 13th. All but one Mag 7 name finishing the day today in the red. A lot of questions right now about market valuations in that space. Sarah Kunst joins us right now, Managing Director of Cleo Capital. And Sarah, there's been this sort of look at these multiples that we've seen on some of these tech stocks, and I don't know if that was the reason for the pullback, but it certainly has caused a lot of people to take a second look at those valuations and question whether they were justified. What do you think?
I think that, we're in an interesting position where a lot of these names have done incredibly well over the last few years. And so I do think there's a bit of locking in gains. There's a bit of asking how much more can you expect to get out of your 2018 NVIDIA bets, right? It has done a lot for you. And so I think some of it is locking in gains. I think some of it is looking around at the broader macro, seeing that you're in the only bets that tend to be sort of regularly turning out a great return, and asking, should we kind of call it a day and think about where else to go from here? And so I don't think that there's been a huge shift in sort of the underlying businesses or even orders that we're expecting, but I do think that there's a shift.
Well, let's talk about some of the individual movers, because when I was looking at valuations and multiples, there's this idea that it's fine to pay a high multiple if you think the growth rate is there, but you're seeing, at least prior to the last few weeks, people buying stocks that were actually having almost decelerating growth rates, at least based on analyst expectations, like a Palantir and a few others. Then you have other tech stocks out there that I guess have a more meaningful growth rate, but for whatever reason weren't being ascribed the same multiples as the others. Why do you think there was that sort of divergence?
It does feel like there's sort of a tale of two cities here. You have the Palantirs, you have, the Teslas over the last few years. When you look at those valuations compared to revenue, it's really hard to justify. Certainly the latest crop of IPOs, with tech IPOs, you tend to see that there are very high valuations against relatively low revenue, but certainly there's a growth story theoretically to be had. And then on the other hand, you have some of these sort of blue chip tech names, a lot of the Mag 7, the Metas, the Alphabets of the world, that are doing incredibly well. And then you look at their revenue versus valuation and you say, wait, this almost feels undervalued. And I don't exactly understand that. I think that Alphabet in particular is people do not understand how good they are at AI. And while that drives a lot of the sort of growth in some names, it doesn't seem to extend to them. So I think there's a disconnect there that the street sort of needs to catch up on.
Well, it's interesting you say that. I mean, we talk about, NVIDIA is obviously, the main stock, tech stock at least, that everyone is focused on. But we've seen Meta, that stock actually keep pace in terms of its market gains. Google, of course, a bigger laggard in that space. Would you, at these current market levels, be more interested in a company like NVIDIA or more in a company like Meta?
They're very, very, very different companies. Meta, it's wild that you can run around giving individual engineers, maybe managers at best, billion-dollar paychecks, and you still look great on the numbers. And so, when Mark kind of goes off on these side quests, we saw it with the metaverse a few years ago, you have to remember that he has the ability to do that because these are rock solid underlying businesses. WhatsApp, Instagram, obviously Facebook, these are all doing incredibly, well still. And so I would never count that out until we see a market shift in user growth or a competitor that really meaningfully eats up that market share. And then NVIDIA, very different company, but also just really solid. I don't think NVIDIA will be in the lead forever on their chips. I do think they still have a couple years head start. And in trading time, that is a lot of time. And so I like both of those names, even though they are somewhat differently priced.
All right, Sarah, we have to leave it there. Always great talking to you. Sarah Kunst is the managing director over at Cleo Capital on a day here where everyone seems to be focused right now on the continued slide that we're seeing in tech stocks. Just a reminder, NVIDIA does report earnings after the bell on August 27th, so less than a week from now. And of course, we might get a better sense here, at least on the chip side of this AI trade, of how that's holding up and how everything else feeds into it. Of course, also feeding into it is going to be the macroeconomic situation and, of course, the direction of interest rates. When we come back after the break, we're going to arm you with a definitive checklist for Jay Powell's speech at Jackson Hole. We're going to talk to Vincent Reinhart, BNY Investments chief economist. This is The Close on Bloomberg.
I think that's where you're seeing a lot of the debate now is, where's your lean? Is it where do you believe things are too restrictive on the policy rate side or not? I think they're modestly restrictive. I'm still trying to find ways what's being inhibited in the economy from where our policy rate is today. But I think we're on a good path.
Kansas City Fed's Economic Symposium in Jackson Hole, Wyoming, officially kicks off in about 3.5 hours. But our very own Michael McKee had a chance to catch up with the president of the Kansas City Fed, Jeffrey Schmidt, and to ask him about rates and the idea of them maybe potentially being modestly restrictive and still appropriate for the current economic environment. This, of course, as investors gear up for the marquee speech, and that will be from the Fed Chair Jay Powell tomorrow. Michael McKee joins us on the ground there in Jackson Hole, Wyoming. And I am curious, Mike, about the direction of debate right now amongst Fed members with regards to what they think is most important to focus on, the labor market or inflation.
Well, when you talk to them, most of them are focused on inflation. They're more concerned with that breaking out because they don't really know what the effects of tariffs are going to be on prices other than they'll go up. How much and how fast is going to be one of the key questions. The labor market in most of their districts is still relatively strong, they say. They don't see unemployment rising significantly. Companies are not hiring, but they're not firing either yet because they're waiting to see what the impacts are. So in the short run, it's probably going to be more about what happens with the inflation numbers that we get before the September 17th meeting than the jobs report, unless the jobs report is really bad.
Of course, Mike, before the official meetings get started, there's already been a lot of talk about one particular Fed member, and that, of course, is Lisa Cook, the Fed governor there. I am curious as to whether there is any chatter on the ground, not so much just about the investigation into her, but about some of the political pressures overall on the Fed.
Well, what they generally say in private is that it's no fun, but they all fall back on the same language that Fed officials have always used, saying, we don't let politics enter the boardroom door. We are totally focused on what the economy is doing and what needs to be done for the economy. Of course, Jay Powell feels it the most, and now Lisa Cook probably has joined him in that whichever circle of hell it is that Dante picked for Fed officials. And they're having to put up with a lot more than the others, but the others say they do hear it. They just don't let it get to them.
So they don't let it get to them, and I understand that's the public face they have to put on. One other topic of conversation, Mike, of course, is going to be about the Fed's framework. Of course, the last time, it was 5 years ago, when Jay Powell sort of laid out, or at least sort of laid the foundation for what would become that framework. Are we expecting to hear anything about that tomorrow out of him?
We are expecting to hear something about the framework. We don't know how in-depth he'll go on that, considering all the things he has to talk about. But they've been working on this for a year now, and they said by the fall they would be presenting it. The idea is pretty much they go back to what they were doing before the new framework, which was adjusting to the economy as it developed. You might want to call that discretion. That's what Alan Greenspan called it. They may adopt some guidelines for how they think about it, but they're going to get rid of the idea that you should focus on employment because inflation's under control. Obviously, very shortly after they approved the last one, that turned out to be not the case.
Michael McKee out there in Jackson Hole, Wyoming, for the Kansas City Fed's annual economic symposium. A little bit earlier, I had a chance to catch up with former Dallas Fed President Robert Kaplan, now the vice chair over at Goldman Sachs. And here's what he had to say about what he expects for the Fed and the path forward.
I think with this weakening in the labor market, it's going to push the Fed, I think, to be more forward-leaning and maybe do an adjustment in September. But the caution I would give, if they do move in September, I don't think that's the start of a cycle. I think it's an individual decision. Then they'll wipe the slate clean and take the next 6 weeks, try to understand these cross currents again. And so I think they'll shorten up the time frame and take it one meeting at a time.
Former Dallas Fed President Robert Kaplan speaking here on Bloomberg Television earlier today. Joining us right now is the chief economist over at BNY Investments, Vincent Reinhart. And Vince, we have a market that it pretty much thinks that no matter what, we are going to get a rate cut in September. I guess the big question, though, is does that actually, if we're assuming we do get that, is that the start of a rate cutting cycle, or is this going to maybe potentially be a one-off based on the economic data we're aware of now?
If they're cutting rates because they're following their plan to lower the nominal policy rate as inflation falls, then it's going to look like a one-off because they don't have to cut the funds rate all that often. i.e., every once in a while when inflation has fallen enough to accumulate to a point where they don't want the funds rate to rise in real or inflation-adjusted terms, they cut the funds rate. If it's the plan, it's going to look gradual. Treat it as a one-off. It might mean they go in September, then the next time would be December or March. If it is response to weakening economic data, that's the ones that come in a hurry, because the Fed isn't dictating according to a plan, it's reacting to events. Right now, they don't need to go into that emergency mode of reactive. So one, not quite done, but it'll be a while before the next one.
There's been a lot of talk about sort of the dual mandate and the idea that the data that feeds into each one of those mandates individually are kind of diverging, or at least not necessarily in sync. The idea that inflation is still persistent, but you also have a labor market that, at least for right now, still appears to be holding up. What does that dynamic mean for the debate on September 16th, 17th, when the FOMC next meets?
Just about everything. And it's not just that the data are diverging, it's the weights they place to both of their mandates are changing because inflation's fallen. 3 years ago, it was easy. Chair Powell woke up and said, we got to get inflation lower. Everything mattered in terms of inflation. And they didn't put much relative weight, therefore, on the unemployment rate. Now that they're much closer to their goal, the relative weight they put on the unemployment rate, or the maximum employment part of their mandate, has gone up. So it's not that necessarily their view of the economy has changed all that much. It's how they weigh that view of the economy is changing as they get closer to goal. You are right, though. The data are diverging. Inflation seems to have stalled out, and employment growth has slowed a lot. The issue about employment growth is it just because labor supply growth has slowed, given our policies toward immigration, or is it about underlying weaker aggregate demand?
It's one thing that I thought that the Fed President Schmidt talked about in his interview was this idea that once they start meeting at Jackson Hole, that there will be a lot of discussion about the neutral rate. There will be a lot of discussion about the Taylor rule. These are his words here. And really just an overall conversation about whether the way we model inflation, that normal 2% target that has been, or two-ish, I guess now, that we've been so focused on, whether there needs to be a meaningful rethink of that.
Well, some of it should come in the framework review because it's about how you explain you're setting a monetary policy. And as for the venue of Jackson Hole, you got the pictures of big, wide open spaces behind Mike, but actually the participants spend their time mostly cloistered in one meeting room, and they spend a lot of time together outside the conference itself. So they're definitely going to have those opportunities to talk. As for what the chair says tomorrow, it's up to him. It's not what he needs to do, it's what he wants to say. It's probably his last appearance at Jackson Hole, his last appearance as chair, and he's got a long menu of things to choose from, including the framework review, including to tell us how they're going to steer the ship in terms of setting a policy in both the short and medium term, or just talk about the importance of independent central banking. So don't be surprised that the chair could be disappointing with regard to direction of monetary policy, because he's got a lot of stuff to talk about.
On the independent side, I mean, you have a market that is starting to question that independence, largely because of the pressure coming from the White House, obviously on Jay Powell, and at least as over the last 24 hours or so, the pressure on Fed Governor Cook. Do you see the potential that we could see a significant reshaping of the Fed board sooner than what the current terms would suggest?
There's always a chance of that, and the administration has thrown us a number of curveballs, not with regard to just the Fed, but some state institutions elsewhere in Washington, D.C. So that's a risk. There's also a risk of why do you want to stay around in that job if you're going to get nothing but criticized? The reality is we create independent central banks because politicians want somebody to blame, the independent central bankers. They can say it's not their fault. And so part of the job is to accept criticism. The criticism, however, when it gets to issues of the composition of the board, and then it becomes more threatening to what they do. So yes, the threat meter is on the high side.
When they're in that room over this next few days and discussing, and obviously this ends up being a prelude to them, of course, the FOMC gathering in mid-September. I am curious as to, given the precarious situation of some folks on that board, with some terms expiring under other people under pressure, I know public they're going to say that's not going to affect us. But do you think it has the potential to affect us? I mean, we got a surprise at the last meeting when Adriana Kugler decided that she could not attend for personal reasons. And then, of course, we learned a few days later that she was actually not going to be on the board at all.
So absolutely, and for two distinct reasons. The first one is about power. The chair of the Federal Reserve doesn't have a lot of explicit power. They execute soft power, their ability to control the budgets, to be the public spokesperson of the Federal Reserve, to send invitations to their colleagues as they see fit, to trade off current description of monetary policy for the future description of monetary policy. And the chairs that have been successful over the years are the ones who know how to use that soft power. However, Chair Powell has been very successful using that soft power. The clock's ticking down. He can't promise future benefits to another governor or a bank president, or being soft on their budget or encouraging in the public about them very effectively, because his term drops dead in May of next year. So his soft power is eroding. His ability to influence this committee is probably weakening. Second part of it is, hey, they're all human. Mm-hmm. And there's questions of personal ambition. Yeah. It must be nice to be on the short list for potential Federal Reserve chairs. Yeah. There's the pressure of just being criticized all the time, the way you opened it. They do their level best when they walk through the door of the boardroom to conduct monetary policy the way they're supposed to, neutrally. Mm-hmm. But what have they been thinking about? How much of their time, who they've been talking to? That's all. That's all different in an environment where Washington, D.C. is in turmoil.
Who should, I understand the issue of the influence. Obviously, the Fed kind of operates on two sort of the Fed chair influence levels. Obviously, the influence over the other members, but of course also over the market. And I am curious as to whether the market should be paying as much attention to what Jay Powell says with regards to inflation and trying to keep those inflation expectations where he wants them, or should the market actually just be paying more attention right now, quite frankly, to the White House, which at least publicly seems to be driving the conversation much more than Jay Powell?
I think, unfortunately, if you're holding an asset that matures beyond May of next year, the White House has some influence on its pricing, because Jay Powell's influence ends when he's the chair. So I think, in some sense, why has President Trump been criticizing the Fed? Because it works. It signals the kind of chair he wants after Jay Powell. It signals the kind of board members he'll appoint when those opportunities come up. So yes, we got to look past Jay Powell. And the truth is, the overnight interest rate doesn't matter very much. Mm-hmm. What matters is its whole path, and its whole path is determined by the collection of Federal Reserve officials. All that said, where Jay Powell still matters, he reflects how the Federal Reserve works, by consensus, by group, spread out beyond Washington, D.C. So, yes, the White House really does matter for some of the voters, but Chair Powell represents the institution, and the institution is long-lived, the institution has a memory, and the institution has inertia built in to protect itself.
Yeah, well said, Vince. And of course, this is an institution that's been tested in the past several times before from the politics, and of course an institution that continues to survive. BNY Investments Chief Economist Vincent Reinhart, who of course spent quite a bit of time at the FOMC as an economist and advisor. Let's take a look at the after hours trade here. Futures overall still in a holding pattern as we see the individual stories here in the after hours trade, including a bump up in Ross stores, up about 2% here. Maybe a ratification of the idea that the consumer, at least when it comes to some of these off-price retailers, is holding up pretty well. Meanwhile, in the software space, we are seeing a little bit of softness there. Intuit down about 6%. Workday down about the same amount as well. Both reporting earnings, both providing relatively decent guidance, but some concerns about the backlog. And there you have at the bottom of the screen, Zoom. A big beat there on the bottom and the top line. A pop in the shares of about 6% in the after hours trade. This is Bloomberg. Fears about inflation here in the U.S. intensifying. This after the S&P Global Flash PMIs for August did show those tariff pressures persisting, particularly when it comes to manufacturers and as well as when it comes to the services sector. And the idea that, well, a lot of those price pressures are being passed on to the consumer. In fact, the Cleveland Fed President Beth Hammack saying just a little while ago that inflation is too high. So all eyes on Jackson Hole, all eyes on the next Fed meeting, and all eyes on the PC report that comes in between. Omair Sharif joins us right now, the founder and president at Inflation Insights. And Omair, the big question right now, when we talk about inflation, is this a problem right now for companies, or is this a problem that's going to be for the consumer?
Well, I think it's a problem for companies. It has been a problem for companies now for several months. It's already becoming a problem for the consumer. We've seen it really, I would say, in the last 2 months of CPI data, both June and July. We've seen the price of core goods outside of autos, so things like appliances, electronics, really start to ramp up. But I think the troubling thing from the PPI report, which obviously covers way more stuff than the CPI does, but the input costs that producers are facing have been rising pretty steadily since the tariffs were put on earlier this year. And they've started to ramp up even in areas where they were not that obvious, where stuff like apparel was actually not really showing a lot of input cost pressure. But now that's starting to ramp up as well. So it's starting to become more broad-based in terms of the input cost pressures they're facing. We can see from the PPI they're getting more for the stuff that they're producing. And it's just a matter of time before more of that gets passed on to consumers in the coming months.
Well, that's what I'm curious about. There's been a lot of hay made about sort of the gap that we're seeing right now between wholesale price inflation and consumer price inflation. The idea that the wholesale prices are going up much faster than what we're seeing with CPI, with the consumer side of it. And I do wonder, historically, do those things normally converge at some point? And if so, what does that convergence look like? Does PPI come down or does CPI go up?
Yeah, so I think it's important. So I would say there is a tepid relationship between the PPI and the CPI. For some things, the relationship is a little bit stronger. So, for example, at the producer level, when you see producers raking in more for selling, consumer food items, that starts to translate into CPI. For example, we just saw a very big jump this past month in the price of vegetables and fruits. That'll likely get passed on to consumer prices relatively quickly. You see that very similar relationship with egg prices that everyone sort of talked about the last year. You see that at the wholesale level first, then you see it at the consumer level. So for food items, it's I would say there's a better relationship. But you have to remember that the PPI measures a completely different universe than just consumer prices, right? It's measuring also, what companies are getting for producing machinery and capital equipment, which are, aircraft engines and agricultural machinery and things like that don't necessarily are not, these are not things that you go out and buy at Home Depot on the weekend, right? So it's not really going to translate into the CPI. So some items also are covered in the PPI that just don't exist in the CPI at all. So part of what drove the PPI, for example, this month was investment services. So, stock market went up a lot in Q2. That showed up in the PPI services data. That does not exist in the CPI. So you have to be very careful kind of thinking about the pass-through from wholesale into retail. For some items, it is robust. Other items, there's just not going to be any pass-through because they're measuring different things.
All right, Omair, I got to leave it there. Omair Sharif is the founder and president at Inflation Insights, of course, with the market zeroed in on inflation readings, including that S&P Global PMI data that we got this morning. And, of course, the Fed, at least based on the FOMC minutes from the last FOMC meeting, we got those minutes yesterday. That also showed that the majority of Fed members also seem to be tilting to a much greater focus on some of those inflation numbers. We should point out that the next big reads on inflation, we're going to have to wait a little bit longer. We get the PCE numbers, the monthly numbers coming on August 29th. But after that, we're going to have to wait to after Labor Day before we get the next read on CPI, PPI, as well as some of the import prices that feed into both of those measures. We'll be back in a moment. This is The Close on Bloomberg. There aren't a lot of catalysts out there to drive the market. Here's what to keep an eye on over the next 24 hours. No major earnings here in the U.S. and no economic data in the U.S. either. We are going to get a couple data points overseas, including GDP numbers for Germany, as well as retail sales in Canada. The lack of catalysts, the lack of data points, well, that means that all eyes are going to be on Jerome Powell, the Fed chair, set to provide his keynote address to the Jackson Hole Economic Policy Symposium. And that will potentially be the big market catalyst. Full coverage of that on Bloomberg Surveillance right here on Bloomberg tomorrow, starting at 9 a.m. Eastern time. And kind of fitting for a market that has hung on everything coming out of Washington. So stick around as we wrap up the close. Balance of Power team takes over and they continue that drumbeat to the Fed Symposium, a conversation with the former Vice President of the U.S. and the current Chicago Fed President, Austin Goolsbee.